Alright, in this accounting101.org video, we're going to go over what a balance sheet is. So a balance sheet is one of the main financial documents that a company uses to organize their financial information. And a balance sheet, like this sentence says, is basically a snapshot of what the company owns and owes at any given moment in time. That's a really simple way to think about it. And a balance sheet is made up of three parts. The first part is assets, second part is liabilities, and the third part is owner's equity. And the basic equation for understanding a balance sheet is assets will always equal the liabilities plus stockholders' equity. And I did put this down wrong. Owner's equity is usually the term for a sole proprietorship. It's the more proper way to say it is stockholders' equities, but it's the same thing. So the assets will always equal these two put together. So one way to think about it is the liabilities are the portion of the assets that the company owes to someone, and stockholders' equity is the portion of assets that is owned by the stockholders. And so the assets are things that a company owns, as well as the resources the company has to use. A restaurant's assets would include the building, its kitchen equipment, ovens, pots, pans, whatever type of equipment they have in the restaurant to cook the food. And then the food that it keeps in stock would be its inventory, which is also an asset. Now, this doesn't necessarily mean that the assets are always paid for. For example, just like you own a car, if you are making car payments on a loan, then your car is an asset, but your auto loan is a liability. So that should make sense to pretty much anyone. And it's really the same concept in accounting. So a company can have assets but have loans or things they need, things that they owe to creditors or banks or whoever, and that's why the accounting equation will always be that the assets will equal the liabilities plus owner's equity. Another balance sheet concept that deals with the assets is depreciation. And depreciation is something that reduces the amounts reported each year on the balance sheet. For example, if ABC Company bought a new truck for its business for $20,000, and ABC estimates that the truck has an estimated useful life of 10 years, that just means that they think they're going to be able to use it for 10 years before they either sell it or it doesn't really work anymore. So you would divide the $20,000 by 10 years, and you would get depreciation of $2,000 per year. That just means that the value of the truck as it's listed on ABC's balance sheet would go down by $2,000 every year. Now, liabilities are the obligations of a company. If we take ABC's new truck, for example, that we just mentioned, if they had purchased the truck by taking out a loan for the $20,000, then the truck would be listed under assets, and the loan for the $20,000 would be listed as a liability. That's because they have to pay that back to the bank. So the truck is their asset, but they also have the liability of the loan against that truck. Other examples of liabilities are just bills that the company owes, wages owed to employees that haven't been paid yet, or interest owed to banks or other creditors. Now, the stockholders' equity portion of the balance sheet is the portion of the assets that the owners or the stockholders own. Now, because of this, like we said earlier, the stockholders' equity will always equal assets minus liabilities. So if we go back up to this basic equation, if you have the assets and you minus the liabilities from the assets, then you'll be left with owner's equity, because again, assets will always equal the liabilities plus the owner's equity, stockholders' equity. Well, if we look at this sample balance sheet, for ABC Company. This is usually what it'll look like. This is very, very simple. You'll have assets on the left side, and you'll have both liabilities and stockholders' equity on the right side. And as you'll see, you add these up as you go down. Current assets, cash, inventories, $10,000, $500. Property, plant, and equipment, $1,000. That gives you total assets of $2,500. And then if you look at liabilities, current liabilities include accounts payable, interest payable. Total liabilities equal $1,250. And then stockholders' equity is $1,250 as well. If you add those two numbers together, you would get $2,500, and you'll see that total assets of $2,500 equals the liabilities and the stockholders' equity. Total liabilities and equity put together equal $2,500, so they equal each other. Assets equals liabilities plus owner's equity.